In financial analysis, you learn pretty quickly that not all profit is created equal. So today, we're going to move past the basic accounting rules to tackle a much deeper question. How do you separate true economic value from, well, internal noise? It's time to pierce the veil of internal profit. And that brings us to this central paradox, which almost sounds like a riddle. When is a profitable sale not a profit at all? This isn't just a trick question, it's a fundamental challenge when you're analyzing any corporate group. And the answer is really what separates accounting appearance from economic reality. For any serious investor, getting this right is everything. You see, the whole issue stems from what we can call the internal profit illusion. Think about it. For you, an external shareholder, any transactions happening inside a corporate group, say between a parent and its subsidiary, are just noise. It's like moving money from your right pocket to your left. Nothing has really changed. The only economic signal that truly matters is a sale made to an outside party. That's the real thing. So to filter out all that noise, we have to adopt a very specific analytical lens. We need to stop seeing the individual companies and instead define a clear economic boundary around the entire group. And this is the absolute foundation of the single economic entity concept. So what is a single economic entity? Well, the formal definition is a parent and its subsidiaries presented as if they were one company. But here's a better way to think about it. For an investor, this isn't some accounting fiction. It's the economic truth. You didn't just invest in one piece of the puzzle. You invested in the whole enterprise. Okay, so on their own, you've got parent co and sub co. Legally, they're two distinct entities. Each one has its own set of books, its own income statement, its own balance sheet, and yeah, they can and often do sell goods back and forth to each other. But the moment we consolidate, we draw a boundary around them. And this is the critical shift in perspective. From inside this boundary, value is only created for shareholders when a transaction crosses it, when a sale is finally made to an external customer. Everything else is just an internal transfer, just moving things around. I know this can still feel a bit abstract, so let's make it completely concrete. We'll use a simple, intuitive example to show exactly how an unrealized profit gets created, and more importantly, why it has to be eliminated. All right, here's the scenario. First, parent co makes a widget for $70. Simple enough. Next, it turns around and sells that widget to its own subsidiary for $100, booking a nice little markup. But, and this is the absolute key, at the end of the year, that widget is still sitting in the subsidiary's warehouse. It has not left the group. Now, this creates two totally conflicting realities. If you look at parent co's internal books, it looks like it made a $30 profit. But from the consolidated investor's perspective, what actually happened? Well, the group as a whole spent $70 of cash to create an asset, inventory. That asset is still sitting there. No money has come in from the outside world. So has the group's net worth changed? Nope. Its economic profit is zero. That $30 is unrealized. It's not real yet. So why does this matter so much? I mean, it's just an accounting entry, right? Wrong. Failing to eliminate this unrealized profit sends distorted signals that can lead to some very bad decisions. And it affects everyone, from internal managers to external investors. For one, it creates a margin illusion. If you just naively add up the parent's internal sale with the group's results, you're bloating both revenue and profit with phantom numbers. This artificially inflates the group's profit margin, and it sends this false signal that performance is way better than it actually is. And this distortion doesn't stop there. It also corrupts one of the most important metrics we use for valuation: return on invested capital. By pumping up the return part of that equation with unrealized profits, the company reports a totally misleading ROIC. And that can trick both managers and investors into thinking that capital is being deployed far more effectively than it really is. This quote just nails the problem perfectly. It misleads everyone. You have managers, whose bonuses might be tied to these flawed divisional profits, suddenly incentivized to just sell stuff internally, even if it creates zero shareholder value. And then you have the market, which depends on these numbers for valuation, getting a completely warped picture of the company's health. And that brings us to the true purpose of elimination. Look, this isn't just about ticking a box for an accounting standard. It's a fundamental process of analytical clarification. It's about cleaning the lens to give investors a clear, undistorted view of a company's actual performance. So, to sum it all up, these eliminations are absolutely essential. They strip away all that internal noise to show you what's really going on with economic performance. They make the reported earnings much higher quality, giving us numbers we can actually trust. They provide a clean, accurate basis for evaluation models. And maybe most critically, they help align what managers get rewarded for with what actually creates value for shareholders. So we'll leave you with this final thought. Now that you can see how a simple internal sale can completely distort financial reality, the real question becomes, what other accounting choices, what other corporate structures might be out there, hiding the economic truth? And asking that question, well, that's the essence of sophisticated financial analysis.